You are listening to Charting Wealth's weekly review and forecast for the week beginning Monday, the 1st of August, 2016. Let's jump right in. Now, for those of you joining us for the first time, this is what we do at Charting Wealth for our weekly review and forecast. We review all four of our charts: IYY, the total market; SPY, the S&P 500, QQQ, the NASDAQ 100, and gold. We look at them on the weekly, and we look at them on the daily chart throughout the past week. We then will have a review as to what affected the markets this past week and what may be affecting them in the coming week. That's why it's called the weekly review and forecast. Let's go ahead and jump right in. First thing we'll look at is IYY. Again, that is the iShares Dow Jones U.S. Total Market Index Fund. It's an exchange-traded fund. In other words, it's a basket that reflects all the stocks in the market. And what do we see? We see the fourth week of up green candles. Now, the up movement appears to be slowing. The candle is the smallest since the first candle of the four, and each candle represents movement over the course of a week. The first green up candle we see is on the 8th. Ending the week ending the 8th of July. The next is on the 15th and the 22nd, and the final one is on the 29th. All of those are green up candles since the market turned over and started moving up after the down week on the 1st of July. So we are in a confirmed up move in the total market. Now, for those of you who are keeping up with things on your daily worksheet that we have available at the website, of course, everyone who subscribes to our podcast, all you have to do is go to chartingwealth.com, subscribe. We will send you a link to our PDF where you can print out many of those, and you should do one every day. So remember, IYY is in a confirmed up move, so you can put an up arrow as far as that little circle goes, as far as what IYY is doing. Again, we have four candles representing 4 weeks of up movement. And we go from the weekly to the daily. What do we see happening? Well, the daily is really interesting because we can see, on the daily chart that we have movement sideways since about the 14th of July. When you look at the daily chart, it sure looks like a great deal of sideways sliding movement. And the market actually crossed over going down on the daily at the end of the week on the 28th and the 29th, Thursday and Friday. The week opened again with a red spinning top and pretty much spinning tops throughout. Did see Friday ending up with an up move on our Heikin Ashi type candlesticks. The market on Friday was up 0.22%. But again, we do have it crossing over going down on Thursday. This market has been sliding sideways since roughly the 15th of July. Now, again, our Heikin Ashi candlesticks represent different things than just your standard open, close, high, and low. And they help us really see patterns. So the pattern is the weekly chart is still in a strong up movement. The daily is showing a lot of slowing and sideways sliding, and actually crossed over at the end of the week. And we have the derivative oscillator is in the negative there. Again, we'll look one last time at the weekly chart, and we can see that slowing being depicted in the 2 candles for the last 2 weeks topping out. Now again, we still have confirmed up movement. We don't have the blue MACD line getting close to the signal line yet. It did kink over from the last week, so some of that growth has slowed. And again, that's the reason we look at both the daily and the weekly. We did close out of the Bollinger Bands on the last 2 weeks. So again, strong up movement, but does appear to be pairing off. Derivative oscillator still heating up. The MACD and the derivative oscillator are still diverging. So keep that in mind. That's where we stand. Weekly chart is in an up move. Now let's see how much different the S&P 500 looks. It was up on Friday 0.16%. Looks very similar to the total market. Again, 2 candles, the last 2 candles ending up at about the same place, a little bit higher for the week ending on the 29th. But again, all the upsurging started on the 8th of July, and we've had 4 up candles, green open box candles. Remember, when we start seeing red open box candles, indecision. We see red solid candles, down movement. So and for those of you who want to understand Heikin Ashi candlesticks better, it means average pace in Japanese. Please go to Charting Wealth, go under training, and you will see our video. We did I think I've gotten a lot of compliments from you guys on it. Some people have said it's the best they've ever seen on Heikin Ashi, and we appreciate that. Please go there. We've tried to boil it down. Again, one thing we do is we keep things as simple as we possibly can. Occam's razor. That is, keep things as simple as you possibly can. And like Einstein said, but not simpler. You can only get so simple. You go beyond that, it becomes worthless. So we try to hone it down and make it easy, because that's what it needs to be. It gets complicated, you get confused, you make mistakes, things don't work. The more complicated something is, the more likely it is to break, right? So let's continue to look what happened intra-week. We will look at the daily chart on the S&P 500. And again, we see this sideways slide, and we see a rotation over the MACD going through the signal line down, derivative oscillator flipping over at about the same time. So the daily is in a negative with that slide. So again, remember, all things being equal, the market always tends to move in the direction of the big chart until it doesn't anymore. That means the daily chart has to become strong enough to pull down the weekly chart that represents 5 times the size. So again, think of these things in waves. That's the most important way for you to understand them and to continue to think about them. The big wave is up. The little wave appears to have peaked, but we shall see. The big wave can pull it back up again. We'll keep watching. Okay, now let's go to the Qs. Again, remember the Qs of the NASDAQ 100, the tech stocks. It crossed over on the 8th, going up. Again, we have 4 candles, strong upward movement. The NASDAQ has continued to have stronger up movement than the total market and the S&P 500. We see that depicted in these candlesticks. Still continued strong up movement. No kink over, sort of breaking the up movement of the MACD as we saw in IYY and SPY. Continue to see an arc of strong up movement on the MACD. Again, diverging from the signal line, which continues to move up to strong up movement in the candlesticks, a strong up candle for the week ending the 29th, and we've seen strong up candles the whole time with big wicks on top, which means the market went even higher. The bulls were able to push it up even higher. The bears pared it down a little bit. Again, for the day, the Qs was up, NASDAQ up 0.22%. for Friday. Now let's look intraday and see what we see on the daily. We see that the week opened on the 25th, and again, strong, not sideways sliding like we saw in the other 2 indexes, but up movement every single day of the week. Now we do see the derivative oscillator actually gain some energy throughout the week. The MACD and the signal line are pretty much paralleling each other, still going up. And again, we'll just continue to watch and see how things develop. So mark on your charts, the weekly for all 3 of the indexes is confirmed up. However, we're just keeping in the back of your mind that daily does look like it's petering out as far as its sideways slide for 2 weeks on both the total market and the S&P 500. Now, lastly, before we get to the news, we will look at gold on the weekly. Gold has basically been peaked out back on the 8th of July. Then we had a lot of indecision with a red open box, spinning top, with a lot of up movement, a little bit of down movement as far as the wicks go, followed by, that was on the 15th, followed by a strong down candle on the week ending the 22nd. And then the week ended on the 29th with a green spinning top, a doji pretty much, which again means the market opens and closes at about the same point, showing lots of indecision as far as gold goes. Gold is still in a confirmed up move, however, on your weekly chart. And all the down movement over the last 3 weeks has all been contained in the up movement in the prior week of the 8th, ending the 8th of July. So keep that in mind. Basically, It's a big sideways slide is what we've been seeing. Now let's look at what's depicted on the daily. We see on the daily chart the market peaking out right there around the 6th of July, dropping off. It crossed over going down on the 13th, and now looks like it's getting close to crossing over going up on the daily. In fact, the derivative oscillator on Friday crossed over going up. We saw on Monday the market opened down in gold, then started moving up, broke the 2-day trend line on Wednesday, and continued up Wednesday, Thursday, and Friday. And again, gold on Friday up just a little over 1% at 1.03%. So again, if indeed we do see gold crossover on that daily, then of course we'd have the daily and the weekly in confirmed up moves. But gold, as far as the charts go on the daily, has been moving down until around Wednesday. And as far as the weekly chart goes, gold is still in a confirmed up move, but really 3 weeks of sideways sliding, and it's gotten weaker. Derivative oscillators weakened, and the MACD's gotten closer to the signal line. Now, that's where we are. So mark all your charts. Every one of us is a confirmed up move on the weekly chart. Let's talk about what made news over the last week, what affected the markets, and then what might be affecting the market in the new week news-wise. First, we see the U.S. growth data disappointed. Did that affect the markets at all? No, it really didn't. It just is so interesting, particularly in light of the Fed meeting on Wednesday. But let's talk a little bit about U.S. growth. Economists had expected an uptick in growth in the second quarter, but they were disappointed. The economy grew at just 1.2% annually. And again, folks, that is very slow growth. They did say on the bright side, consumer activity was robust, but on even more downside news, corporate investment was a drag on headline growth. And again, you're looking at problems in the Eurozone. Their growth came back at 1.6%, and that happened to be in line with consensus forecasting. What did the Federal Reserve do for us this last week? Well, they actually, even though U.S. economic news was poor, the Fed nonetheless upgraded their outlook on the economy. They said that near-term risks had diminished, and they pointed to improved employment figures. Folks, you can always find a cloud, an open patch of sky somewhere if you look hard enough. Well, that's all investors needed. Everybody was afraid that they would be contemplating a rate hike before the end of 2016. And the fact that on Friday, weak GDP data cooled rate hike fears is probably what ended up fueling the up moves that we saw in the market on Friday. Is that not crazy? Bad data, meaning that the economy's not doing all that well, sent the market up because it means the Fed won't be getting rid of free money sooner rather than later. That's just insane. But hey, you've got to know how things work. What is driving the market? It is free money. And some people will tell you the reason the stock market keeps going up, well, one of two reasons that I have heard that I tend to put some faith in is we are in an election year, and the market almost always goes up in an election year. When this year's over, watch out, my friends. That's why you need to know how these charts work, how to read them, so that you can get out of the market at the right time. Because again, the worst thing to try to recover from is losses. Okay? It's great to make money, but you do not want to lose money. And one of the biggest things that you empower yourself doing by staying with us every day, looking at these markets, is when the going gets tough, when everything gets bad, you've got to know how to get out of the market and when to get out of the market at the right time. Okay, next thing that we need to move on to is looking at Backlash Fears. The G20 leaders have been doing what they can with populism on the rise, trying to deal with calls for inclusive growth as a core goal at their meeting that they had in China. That's going to be interesting. Again, China's having its own woes and problems, so we'll see how that impacts and plays on things. Of course, Hillary Clinton accepted the Democrat nod. Now we have our two candidates in the U.S. for president, Trump and Clinton. We'll see how that plays out. And again, remember, the presidential cycle is one of the most dependable cycles. And if you don't know and understand that cycle, please go out and buy. You can order on Amazon right now the Stock Traders Almanac for 2016. I think it's page 72. I may be wrong, but you can look in the index. You need to understand this presidential cycle. It is fascinating, it is interesting, and it is typically accurate. I mean, very, very accurate. So pay attention to that. Now let's look at, so we've talked about sort of what moved the market over the past week, the news that came out, and the fact that, again, what the Fed says seems to matter more than anything else. And this market keeps going up, 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 despite bad economic news, despite poor reports. As long as the Fed keeps the tap open on free money, the market keeps going up. You might say, well, how does it keep going up? Why? Is it just inflation? Is it just they're printing money, giving money out for free, and things that actually have value are increasing in price because the money's becoming weaker? I don't know, my friends. It may be a combination of that and many, many other things. We just care about what the charts tell us. And as long as the charts show us going up, then we want to make money going up. If they show the market going down, we either want to get out and or make money when the market goes down. How do you do that? Inverse ETFs. Another point by us to go to Charting Wealth, look at our training that we have, the video on inverse funds, how to make money when markets crash, please. And we'll give you information about the problems with inverse funds, how they can't be a long-term investment vehicle, but how you can use them wisely. Now, lastly, let's look at, and then we're going to let you go. We're going to actually go and record the daily show for Monday. We want to talk about what's ahead as far as news goes. Well, the global manufacturing purchasers indices are going to be released on Monday the 1st. We also see the global services PMI. That's going to be released on Wednesday. Then Thursday, the Bank of England Monetary Policy Committee meeting is going to set its rates on Thursday. And on Friday, U.S. employment reports are going to be released. Again, what can have the most impact? Maybe the U.S. employment reports on Friday if things are really, really bad or really, really good. As far as the other things, again, what I tend to find over and over again, if the news is super bad or if the market just wants a reason to go down, and hopefully you can see that running in the charts and you can plan for that. But again, pay attention to the charts on a daily basis. Know what your weekly charts are doing, and then join us every day. Use your daily worksheet, work that every day, fill it out. And again, I encourage you to do it by hand. Why? There is something magical about a human writing on a piece of paper. Somehow, I feel like it transfers the knowledge, the thought process into your brain so much better. Try doing that. Give it a try for 2 weeks and see how it works as far as improving your ability to forecast, because that's what you're doing. You're learning to read a map, and the map is the stock chart. Whether you're a value investor, whatever you might be, if you just have some money in stocks and you want to make sure that when the market goes down, you get out and don't lose what you've gained, that's what this will help you with. If you want to be somebody that tries to jump in later and make money every day in the market, first thing you need to do, educate yourself with us. We're not a stock calling service. We don't tell you when to buy, when to sell. We want you to learn with us. And then once you do that, you can make your own decisions when you feel comfortable enough. We don't get paid to call stocks. We do not call stocks. We're an education firm. Thank you so much for joining us for the weekly review and forecast. If you would like to do something nice for us, we just ask you to go to Charting Wealth's YouTube channel and subscribe. We're getting closer and closer. We're up to about 800 subscribers. When we hit 1,000, guess what we can do? We can start supplying proprietary broadcasts directly to those first 1,000 subscribers. Be one. Help us out if you appreciate what we do for you, free every day, and then the weekly review and forecast. In addition to that, go to iTunes, subscribe. You help us with the metrics there when you subscribe. Please make sure you do that and give us a 5-star rating. You've made us as high as like number 6 or 7 as far as the stock market podcasts go in the world, and we very much appreciate your support and your help and all the nice things you say about us. When you feel interested, please go to Charting Wealth. Email us from there. Tell us what your problems, concerns are, what we can do for you. We always love to hear from you. We'll be happy to provide additional training in areas that you are interested for us to provide it in. And we will just continue to do all we can to help you learn how to read these stock charts. There's nothing more important in trading and investing than being able to read a chart. Who wants to buy too high? Who wants to sell too low? Okay, my friends, thank you so much. We appreciate you being with us. Again, God bless you. Hope you have a great week trading from chartingwealth.com.